Hello and welcome to our guide on financial well-being. Today's discussion will cover the importance of managing debt. Let's begin. Managing debt is a critical aspect of personal finance and should not be taken lightly. In today's world, it is common for individuals to have multiple sources of debt, such as credit card balances, student loans, and car loans. While debt can provide a means for achieving financial goals, such as purchasing a home or starting a business, it can also become a burden if not managed properly. Debt management is the process of creating a plan to repay debt in a timely and effective manner. It involves understanding the types of debt you have, the interest rates and fees associated with each, and the impact they have on your overall financial situation. By taking control of your debt, you can avoid falling into financial trouble and enjoy the benefits of having a solid financial foundation. Understand the types of debt you have. Consumer debt or non-consumer. Consumer debt and non-consumer debt are two distinct types of debt, with different purposes and characteristics. Consumer debt is debt that is incurred for personal, family, or household purposes, such as buying a car, financing a vacation, or paying for daily expenses. Examples of consumer debt include credit card debt. This is the most common type of consumer debt, where individuals borrow money to make purchases on their credit cards and pay back the balance over time, usually with interest. Personal loans. Personal loans are unsecured loans that can be used for any purpose, such as debt consolidation, home improvement projects, or medical expenses. Auto loans. An auto loan is a type of loan used to purchase a vehicle. Student loans. Student loans are a type of loan used to finance education. Non-consumer debt, on the other hand, is debt incurred for business or investment purposes, such as financing a business, purchasing real estate, or investing in the stock market. Examples of non-consumer debt include business loans. Business loans are loans used to finance the growth, operations, or expansion of a business. Mortgage loans. A mortgage loan is a loan used to purchase real estate, such as a home or commercial property. Corporate bonds. Corporate bonds are debt securities issued by companies to raise capital. They are similar to loans, but are bought and sold on financial markets. Investment loans. Investment loans are loans used to finance investment opportunities, such as the purchase of stocks, bonds, or mutual funds. In general, consumer debt is typically unsecured and carries higher interest rates than non-consumer debt, which is typically secured and carries lower interest rates. Additionally, non-consumer debt is often tax deductible, while consumer debt is not. It is important to understand the differences between consumer and non-consumer debt to make informed decisions about borrowing and investing. Secured and unsecured debt are the other two different types of debt, based on the level of collateral or security that is provided by the borrower. Secured debt is debt that is backed by collateral, such as a home or a car, which the lender can seize if the borrower defaults on the loan. For example, a mortgage loan is a type of secured debt because the borrower's home serves as collateral for the loan. If the borrower fails to make the payments, the lender can foreclose on the property and sell it to recover the loan amount. Unsecured debt, on the other hand, is debt that is not backed by collateral. If the borrower defaults on the loan, the lender cannot seize any assets to recover the debt. Examples of unsecured debt include credit card debt, personal loans, and student loans. In general, secured debt is considered less risky for lenders because of the collateral that is provided, and as a result, it usually has a lower interest rate than unsecured debt. Unsecured debt, being higher risk for lenders, usually has a higher interest rate. Additionally, unsecured debt is often more difficult to obtain, as lenders are less likely to approve a loan without collateral to back it up. It is important to understand the differences between secured and unsecured debt when making financial decisions, as they can have a significant impact on the interest rates, terms, and overall cost of borrowing. One of the most important steps in managing debt is to create a budget. A budget is a tool that helps you track your spending and income, and make informed decisions about how to allocate your resources. By including all of your debts in your budget, you can get a clear picture of how much you owe and what you can afford to pay each month. This will allow you to prioritize your debts and determine which ones to pay off first. Another important aspect of debt management is to keep track of interest rates and fees. Interest rates can vary greatly from one debt source to another, and it is important to understand the impact they have on your monthly payments and the overall cost of the debt. High interest debt, such as credit card balances, should be a priority for repayment, as they can quickly become a burden if left unpaid. Keeping track of interest rates is important for several reasons. Cost of borrowing. Interest rates play a major role in determining the cost of borrowing. The higher the interest rate, the more expensive the loan will be. By monitoring interest rates, borrowers can make informed decisions about the cost of borrowing and the amount they will need to repay. Loan comparison. Interest rates are a key factor in comparing different loan options. Borrowers can compare interest rates to determine which loan offers the best terms and the lowest cost. Investment decisions. Interest rates also play a role in investment decisions, as they impact the return on investments such as bonds, savings accounts, and certificates of deposit. By monitoring interest rates, investors can make informed decisions about where to invest their money to maximize their returns. Impact on debt repayment. Interest rates can have a significant impact on debt repayment, particularly for those with high levels of debt. By monitoring interest rates, borrowers can make decisions about debt repayment strategies, such as whether to transfer balances to lower interest credit cards or to consolidate their debt with a personal loan. Budgeting. Interest rates also play a role in budgeting, as they impact the amount of money that borrowers need to set aside each month to repay their debt. By monitoring interest rates, borrowers can make informed decisions about their monthly budgets and their ability to repay their debt. In conclusion, keeping track of interest rates is an important part of managing one's finances and making informed decisions about borrowing, investing, and debt repayment. It allows individuals to understand the cost of borrowing and to compare different loan options, making it easier to make the best financial decisions. In addition to paying off debt, it is important to maintain a good credit score. Your credit score is a measure of your creditworthiness and is used by lenders to determine whether you are eligible for a loan, and at what interest rate. A good credit score can help you get better interest rates on loans, lower insurance premiums, and increase your chances of being approved for a mortgage or a job. To maintain a good credit score, it is important to make all of your payments on time and keep your credit card balances low. Managing debt is an essential aspect of personal finance. By creating a budget, keeping track of interest rates and fees, and maintaining a good credit score, you can avoid financial trouble and enjoy the benefits of having a solid financial foundation. If you are having trouble managing your debt, it may be a good idea to seek professional advice. Are you looking to improve your financial well-being and achieve financial security and independence? Our channel is dedicated to providing practical tips and strategies for budgeting, saving, investing, and managing debt. We strive to empower our viewers to make informed decisions about their money and achieve their financial goals. Don't miss out on valuable content by subscribing to our channel. We also appreciate likes and shares on our videos, which help us reach a wider audience and continue to provide valuable content. Additionally, following our channel will give you access to our community where you can connect with like-minded individuals and discuss financial topics. Thank you for watching and have a great day.